everybody to our Bay Area Housing Market Town Hall. Today is October 13th. What we're going to go over today is about the Bay Area housing inventory and market trends, the mortgage rate, and also looking at the mortgage rate trends and also your purchasing power. And also now we're 18 months into this COVID pandemic, and let's look at the economic side effect of this pandemic. And also we have, as you know, the eviction moratorium that's expired in California. So what kind of renters protections program are still out there? And then of course, we have to talk about the multifamily investments, the rental rates, cap rates, and the trends. And then we're gonna start with Tyler teaching us the secrets to a successful syndication, no matter if you want to put it together or if you want to invest into one. As always, we always want to show you what's been going on, because we talked about during the summer has been a little slower. And then September, a lot of kids have gone back to school. The market typically come back a little bit. And if you look at Newark, the townhouses, they still have multiple offers. Pretty much everyone has multiple offers, and everything has sold. What we've seen here is sold over asking price. And in Newark, which is in the East Bay area, 4 offers still got about 10% over asking price. So the one that for asking $999, $800 obviously had gone over $1 million. And Santa Clara, Cupertino, Sunnyvale, they're still really, really hot. They have multiple offers. They also have cash offers that have gone over 10 to 20%. As you see that a lot of these offers were about 10% over, besides the cash offer for close to $3.4 million property. It went only about 3.3% over. And then in Campbell, even the price point is slightly lower at $1.2, $1.3 million. For single family 1.3, it's hard to find in Campbell still. That's why they got 8 offers, and it went about 12% over asking price, and townhouse went about 4% over asking price. And the Milpitas, there were 3 offers for this townhouse, and it went 11% over. And then the San Jose Willow Glen, and Willow Glen, which is more on the west side, and the Silver Creek more on the southeast side. And even these high price point properties, before the offer deadline, they got 5 preemptive offer and still went 10% over asking price. So just want to show you guys how competitive it is still out there. Although I don't know if you guys remember, you guys can go back to look at a couple months before, around April, May timeframe, you'll see the number of offers. A lot of them were double digits. Over here is a little bit more of a single digits, like less than 10 offers besides the one in Santa Clara. So that would give you a little bit good reference. So when it's your turn to make offers. Let's look at in Santa Clara County housing stats. Let's compare between August and September. And in August, as you see that for single family closed sales, we actually went down a little bit compared to a month ago. And if you look at last month, it also went down from July. So we've been going down in terms of number of closed sales, but it's still up about 11.5%. And same thing for condo, was continued to go down since July. That's gone down, and we went down another 4.7%, but it's 35% more than a year ago. And in terms of the median price in Santa Clara County, it's $1.65 million. It did come down a little bit, 2.1% from last month to 1.615. And also the condo townhomes also came down a little bit to $910,000. But again, both of the prices have gone up double digits since last year. And then let's look at the days on the market. The days on the market has gone up a little bit from last month. As you see that from July, it was about 13 days, and August was 14, and now September is 15 days. So you see the market has slowed down a little bit, and it's pretty normal as we see that towards the end of the year, the days on the market typically goes up slightly. And also same thing for the condo and townhome market, but again, of course, it still had gone down quite significantly compared to exact time frame from last year. Now, I thought to share these chart with you guys. This is quite interesting. If I pull all the data, the number of active sales and the number of sold since 2004, as you see that the inventory, so the yellow line, it has fluctuated quite a bit. But then the number of sales, how many sales, they are staying pretty consistent. So we can really see, especially this part, right? These large inventory here, honestly, at that time, between 2007 to 2011, 2012, most of you know, that time I would say that 90% of even my sales at the time were all short sale or foreclosure. And it was that much inventory on the market. And then of course it had dropped quite a bit since then. And then now is what's interesting that you'll see it has gone down quite a bit compared to, the inventory now is like less than 1,000 listings in Santa Clara County. But before we had as much as 7,000 listings in Santa Clara County. Now, this other chart that we're looking at, we still have the number of sales, and then the chart squished a little bit, but then it's the same pattern as these red lines right here. However, we're comparing now the median sales price here. So as you see, this is where the price started to drop quite significantly. And if you look at this chart comparing the same period, this chart, you see this huge differences between the number of active listings and number of sold. And the same thing, if you look at another point where it's around 2018 to 2019, you see that the price has gone down. And same thing, there is like quite a bit of like differences between number of active listings and number of sold listings. But I thought more interestingly is that now, as of September 30th, the number of sales has gone above the number of active listings. This really shows you why the price has gone up quite a bit. When you have so many active listings, that's why the price would come down, right? But then when you have more sold, more people buying than the listings on the market, then that's when you see that the pricing would continue to go up. I think this would be quite important to look at, because if you're wondering, hey, will the price starting to drop now? This is an indicator where you see that the demand is still really strong over here. And what's interesting is the condo market also. We're seeing pretty similar a pattern here. And the same thing around 2008, you see this big difference here, and then the price started to drop. But then what I thought is interesting is that there's, besides another drop in 2018, there's also one more drop around past 2019, around 2020 timeframe, where the price has dropped again. As you remember, when the pandemic just started, a lot of people were staying away from the condos and townhomes. So the price drop here is actually probably closer to more like the beginning of the pandemic. So for the townhome and condo, they have a little bit more pricing fluctuations. And then you look at here, same thing, the number of sales versus the number of active listings. They are pretty much, we don't really have any gap here anymore for condo and townhome. So as we see that the pricing here for the condo and townhome probably going to continue to stay pretty strong. And if we look at San Mateo County, the median price is even higher. It's $1.88 million now, has gone up 1.9% from last month, although last month we had a little drop. And we the number of days on the market is a little bit longer. It's 19 days on the market. And then also we have a little bit more sales, 7.08% more sales compared to last month. If we look at condo and townhomes, the price dropped a little bit. We kind of flip-flopped. Last month, the price for the condo and townhome went up, but then this month, the price for the condo and townhome actually came down a little bit, and it stayed on the market slightly longer, and it has less sale as well for the month of September. So if you look at both Santa Clara County and San Mateo County, they both days on the market stayed a little bit longer. And what about Alameda County? In Alameda County, you will notice that here is the number of sales, and the number of sales has been more than the number of active listings on the market. And then this is kind of like, you can see why we have this crazy price increase throughout since last year, July, because we have so much demand in Alameda County. And I'm sure a lot of people who who live in Alameda County have seen that effect as well. We talked about during the pandemic, especially, a lot of people are moving a little bit away from the peninsula. They are moving more towards a suburb area. And Alameda County has a lot of areas that have increased in pricing where we didn't expect that to happen before. So we definitely see these increase in pricing by looking at the number of sales versus the number of active listings. And then if you look at condo and townhome, again, we see number of sales versus number of active listings, and that's why we see these pricing increase as well in Alameda County. All right, so let's take a look at the mortgage loan update and see what's going on. And now our 3Q 2021 is officially over, and we know that Freddie Mac, Fannie Mae, Mortgage Bankers Association, and National Association of Realtors, they had these projections of our mortgage rate at 3.1. I would say that that was pretty close to what it was. And then but then their 4Q projections for Fannie Mae and Mortgage Bankers Association, they actually have adjusted lower again. So now they instead of 3.1 that they projected, they now say that it's going to be 2.9%, and for Mortgage Bankers Association has come down to 3.1%. So make it the average of all four is 3.18%. So their projection actually dropped by 12 basis points. And then the same thing for 1Q 2022, it dropped another 10 basis points to 3.33. And 2022 2Q is 3.45. The rates, they are going up. It's just that their projections have come down compared to 2 months ago. And then they also now projecting 3Q 2022 is going to be about 3.55. So if we are looking at comparing to probably this quarter, we're just going up by about 37 basis points only. Now, to verify whether that projection is correct, Wells Fargo has been very generous to share with us their mortgage rate. And then last month for jumbo loan, their interest rate for 30 years fixed is about 2.75, and then high balance at 3%. Well, this month, so this is September 8th. And then if you compare October, it's 3.125 for conforming 30 years fixed and 3% for jumbo loan. I thought it's pretty amazing, you know, that your jumbo loan is actually cheaper in terms of interest rate compared to high balance conforming 30 years fixed.
Thank you so much for watching our YouTube channel. And don't forget to subscribe to our channel, like our videos, make some comments, because we're going to keep you posted on the most updated real estate news, housing market data, and also real estate tips and advice from all over the real estate industry.
Now, in terms of the macro housing market update, this month, so many people, so many news channels been talking about supply chain shortages. And this does not only happen in the United States. I don't know if a lot of you have seen this. I don't know, Tyler, do you see it in your market as well?
Yes, we're absolutely seeing it personally and professionally. You know, we're doing two major capital expenditure projects on two different properties, total repositions, and we're having major issues with materials, of course, labor from all vantage points. Of course, we're also finishing our basement at our home and we're waiting on materials. And so I think we're all feeling it. And furniture, I mean, we're looking at 6 months to receive furniture in some ways. We're redoing a clubhouse on one of our properties and we're looking at 3.5 months. And it's pretty interesting for that.
Yeah, as a matter of fact, I started my kitchen remodeling project, the planning side of it, and the appliances we ordered in May. I think today was like, we finally got the last piece of our appliances, and then cabinets is going to take 10 weeks. So we're not going to get it until December. It's like, we just
I know.
wait.
We're all dealing with it. It's crazy.
Yeah, you see that a lot of remodeling projects just sitting there taking forever. So, however, I definitely want to touch on later. It's like, if you do want to do remodeling, you better do it now, because the shortages is not just here again in the United States. It's like UK, Australia, it's global, Asia, all over. They all have supply chain shortages. You'll see that in Long Beach, the port, they said right now almost 100 ships, just container ships, is just sitting there not able to come in. And there are a lot of reasons why, you know, we have this supply chain shortages. You might say like, why are you talking about supply chain shortages? What is there to do with real estate, right? Everything is kind of related to each other, and then we're going to talk a little bit more because when we have supply chain shortages, this affects all the costs: food, gas, travel. Our CPI is already at 5.4%, but that doesn't even include our home prices and rents, right? So we have to take a look at all of that and what kind of effect is going to affect to our housing market as well. And on top of that, federal funds, they have decided not to change their federal fund rates. So it stays there. However, they are forecasting that they're going to have a rate hike in 2022. And one of the reasons is that, we have this money supply issues. I think you guys heard a lot about inflation. One of the main reasons why we're going to have inflation is that before 2020, we had $4 trillion of money supply. And now we have $20 trillion in the money supply, from 4 trillion to $20 trillion. That's a lot of money that just appear out of nowhere. So what are you going to do with all that money, right? The inflation, they already said that the inflation is going to be quite drastic at 4.2%, even though they said like their forecast for 2022 is about 2.2% to 2.1, long-term is 2%. It is still higher than what they would like to see. And again, this does not count the housing cost. I'm sure when you go to supermarket to buy stuff, or even when you're remodeling, you didn't see only 2% increase on those prices. It's way more than that. The labor costs, everything is way more than that. The federal government definitely, they said that they're going to begin gradually tapering this process by mid-November. And what does that mean? It also means that they're going to increase rate in the near future. So when they increase the Fed rates, it's not directly affecting the mortgage rates, but it will cause the mortgage rates to increase. If we look at right now at 3% mortgage rate, when our mortgage rate goes up to 4%, luckily from our projections right now, it doesn't seem like it's going to happen in the next 4 quarters. But again, remember the projections, they can change, right? Almost every month when I do these kind of projections, I always come back to say like, okay, they changed the projections again. Although it wasn't that big of a difference, but still they can still change. Let's just say that if the mortgage rate does rise to 4%, then the housing demand is going to be dampened. People, especially for jumbo loan, you are definitely going to see that big difference in terms of the demand. However, 75% of the homeowners have mortgage rate less than 4%. If the mortgage rate does rise to 4%, what do you think about these sellers? Do they really want to move? If they don't need to move, they probably don't want to move and sell their property. So that means we're also going to have housing supply shortage again, right? So we're going to have lower demand, but we're also going to have a lower supply. So this is going to really affect quite a bit. For this reason, I don't think the price is going to drop like crazy. I think it's probably not going to affect it. I do think that it's still going to go up moderately instead of like right now we see like 15% from last year, but it's still going to continue to go up. It's just that the mortgage rate is going to go up, and then you're going to have less supply in the future. This chart is showing everybody the purchasing power, what it means if just 10% increase in prices. Here's a look at the purchase price every 10%, and assuming the loan amount is 80% of your purchase price. These are the rates that according to the projections right now. So we have already passed our 3Q. If you had bought something at $1 million, your monthly payment is about $3,416. And if the market gone up 10%, then you're going to be paying about $3,757 more instead. But let's say here, it's like this is 8 basis point increase, but it doesn't mean that your monthly mortgage payment only will go up 8 basis point. It actually went up 102 basis point here. So then if you wait 2 more quarters, based on their projections of 3.33%, then your monthly payment has gone up compared to 3Q would be about 2.95%. And then if you wait another quarter, you're actually going to be paying 4.51% more. And then 3Q of 2022, if you wait again, it will be 5.81% more compared to what you're paying here. And then this does not count the price increase. I'm assuming that you're paying the same price. So I'm talking about, like, if you look at this column, you're paying $1 million, you're paying 5.81% more compared to 3Q, but I did not account for if the price has gone up by, let's say, $100,000, how much more that is. So just want to give everybody a reference. It's a one thing about, like, oh, realtor just want us to buy properties because they want to sell. It's more like really want you guys to look at a little bit long term in terms of, because a lot of people buying properties based on their monthly payments. They can lock this for 30 years. It's just like what we're saying right now. If the interest rate does go up, the seller, they don't have to sell. They would just hold on to it because the interest rate is too high for them to move anyway. So think about it a little bit more before you make that decision whether you want to get out of the market or not. Now we want to talk about the aftermath. We talk about a lot of what's going on with the pandemic relief, and we had the eviction moratorium and the interest rate decrease because of the COVID pandemic, right? This is what we have seen, and which caused the money supply went up significantly. And on top of that, we have labor shortage. So the labor cost is also going up. Now we have supply chain blockage now. So one of the things about the supply chain blockage and why all these container ships are stuck at the port is because of the labor shortage as well. So we talked a little bit about this 2 months ago, is that a lot of these benefits actually has caused a lot of people not going back to work. And then, of course, also there's some job loss and a lot of, especially a lot of women and also elderlies, they have decided to completely get out of the workforce because they have to stay at home to watch the kids, or they were just too worried about their health conditions. So we have this labor shortage that caused the supply chain blockage, and which also caused these hyperinflation. And then now, in order to tackle that, now the Fed is going to sooner or later is going to start increasing the Fed rate, and also cause like the mortgage rate to go up, which means the housing demand is going to decrease, and also the housing supply is going to decrease. So what does it mean? I don't know. I mean, Tyler, do you know?
All I can say is that you are a gem, Helen, because there's so much going on. And, you were asking me about what do the numbers look like in my market. While the numbers are a little bit different, everything is interrelated in this global economy. I mean, it's complicated, but we've got to be able to read the tea leaves, and there's a lot going on here. I think that we've got to be bold, right? We've got to move in some direction. We can't just be flat-footed, but there's a lot here.
Yes. I absolutely agree with you. But I think one thing that we know for sure is that inflation is going to happen, and then the interest rate is going to increase. I think those are the two that we kind of know for sure. And in terms of where the price is going to go, we don't know. We don't know. We cannot tell you. It's like, oh, we're going to think that it's going to increase another 10%. No, nobody can tell you that.
Yeah, I mean, if you look at the weight of money, I mean, I was talking to Dr. Peter Linneman recently on my podcast, and he's a world-renowned economist, and he was talking about this weight of money. And if you think about it, it's unprecedented. I mean, the amount of capital injection that we just saw in the monetary supply across the globe has never happened before. And that money's got to go somewhere, right? And where is it going? And currently we're seeing it's going into assets. And of course, real estate, the housing market, but all the other asset classes as well. You're starting to see that inflation felt. And we're seeing that in real time, and cap rates and all these other things. You were just describing it beautifully in your market. And so I think there's a lot to be said about that. I would imagine we're going to see continued asset inflation as well. So what does that mean for your strategy?
Exactly. Absolutely. I think that's why real estate is so important, and everything is related. And on top of that, now I want to talk a little bit about multifamily, right? Especially because of today, we are talking about syndication. And yesterday, we also had another panel. It's a multifamily panel. We had Marco Cugia from CoStar, Joshua Howard from California Apartment Association, and Aaron Frederick from Colliers, who's a multifamily broker. And we were just talking about, well, okay, now eviction moratorium expired. So California have a lot of regulations. With this expired, a lot of people really worry that landlords is going to just start evicting all the tenants. So just to let you guys know that there are still a lot of different tenant protection programs in different counties. So feel free to use this website link. This is where you can find out a lot of different counties. You have different links in there and then see what kind of programs they have to offer tenants and also landlord. On top of that, California, we do have $5.2 billion rent relief programs that's dedicated to help landlords and tenants. But as of yesterday, October 12th, we only have 15.6% funded so far. So we do, there are still ways to apply for these rent relief programs. So be sure to take advantage of that if you do know somebody really need that help. Just because the eviction moratorium is over doesn't mean that you cannot apply for that. And then Marco Cugia from CoStar shared this chart. I thought it was very interesting. If you look at San Jose and San Francisco, which is the green line and a brown line, the rental rates has gone down due to the COVID situation. And then it started to climb back up. But then, as you know, that around June or July, we all thought that, we're going to go back to work around September, October. And so the rent kept going up. However, as soon as they said, like, never mind, nobody's coming back until maybe next year because of the Delta variant, you see that the rate had gone down a little bit. But what I think from looking at this is that we could tell the rental rates is really relying on whether the offices are going to open back up or not. And then Sacramento has been really strong, has been going up during this whole time. Modesto also is really strong. Stockton is one that I thought is really interesting. It has gone up quite a bit as well. And then Santa Cruz also has been going up really, really strong. So a lot of these markets, as you see, the rental rates are really strong. But what we were talking about yesterday was that, you hear on the news that they always talk about mass exodus. A lot of people are leaving California. People don't want to live here anymore. Then why are the rents still going up in that case? Right? So I think sometimes we really, the news take us to believe in certain things, but then and we do see the activities and demand within the Bay Area or within California still. So I just thought to point that out. And then, and also I was very pleasantly surprised to look at this tracker, the rent payment tracker by National Multifamily Housing Council. As you see that in 2019, they collected the first 6 days. This is usually up to the 6th of the month. So before they become delinquent, they collected 79.4%. And then, but then if you look at the last couple months, it's been kind of low, especially September, it was 72% for 2021, but we jumped back up to 78.4%. I thought this is a really good numbers. I mean, even though it's still lower than August, but it is higher than July, higher than June, and slightly lower than May. So at least this is a good number to show. And especially this is after pretty much all the eviction moratorium has been has been expired. And then sales volume wise, though, I know a lot of people are talking about, gosh, I want to invest in multifamily, but then why aren't you sending me any listings? How come there's nothing going on? That's because there's really nothing going on. A very small volume. The volume is so small, and that's why it's really hard to find. It's the same struggle that all the multifamily investors are going through right now in the Bay Area. So you're not the only one. It's just that we really do have a very, very tight inventory right now. And this is also showing you by chart. If you look at the numbers, 7.1 billion in 2019, that was the highest. But then we are one third of what we had before in 2019. And that's why you see that it's so hard to find any multifamily to invest in right now. And then what about the cap rates? Cap rates, back in 2011, Bay Area, it's like 6 cap, but now we actually came back up compared to 2015, 3.8 to 4.4%. But where are we gonna continue to go, right? Marco Cugia yesterday, he had mentioned that he's from CoStar. They have done some analysis as well. Their model shows the cap rates actually will likely stay flat in the near term. And Aaron Frederick also said that because they see so much capital flush into the multifamily sector due to its predictability compared to other commercial real estate sectors, he does believe that the cap rates will continue to level or even go down slightly. So the cap rate, we are pretty low, but also very interestingly, we used to get made fun of where Bay Area has such low cap rate. So then now, if you go to any, like most of the major cities in Texas, everywhere, their cap rate is really low, just as low as Bay Area too, right?
Yes, we're seeing very, very low cap rates across most primary, secondary markets across the US, and 4.4 isn't too bad in comparison. I mean, really. Not.
Yeah. So I mean, we do have some area could be like 2-3%, but really we do see a lot of 3.5%. But again, when we go outside of California, we also see a lot of very low cap rates. So some of the sellers might want to sell. Hey, we need inventory. If you want to sell, this is a good time to sell because the cap rate is so low. And if you look at this chart, is from CBRE research, is that if you see, like, this is a survey to see how does the current pricing stand in relation to pre-pandemic levels in your home market. And 34% of them said that they're willing to bid above asking price, and 58% no discount, and only 6% would say that they would like a small discount, but almost is very, very little that's mid discount. But if you look at compared to office and hotel and retail, they really asking for a much bigger discount, and also shopping mall. So logistic, which is like more of the warehouse, industrial, I should say, and multifamily, they're still holding really, really strong. All right, I'm done with mine. And then now, don't forget to subscribe to our YouTube channel and hit like to our video. Bye.